Hi, Ms. Walker. My topic for the Econ Review video is monetary policy. Our first question is, what is the Fed? The Fed, otherwise known as the Federal Reserve, is the central banking system of the U.S. Its duties include maximum sustainable employment in prices and moderate long-term interest rates. These duties are otherwise known as the Fed's mandate. Our next question is define and explain the four tools of the Fed. Our first is open market operations, or OMO. Open market operations is when the central bank buys or sells bonds in the open market. Buying and selling bonds can increase or decrease the money supply. To increase the money supply, the Fed would buy bonds. This is because the Fed is taking away the bonds and then giving the commercial banks money for the bonds that they got. In order to decrease money supply, they would sell bonds. This is because they are giving them bonds, and then the commercial banks are giving the government money for the bonds, therefore decreasing the money supply. A way to remember this is buying equals big and selling equals small. Our next tool of the Fed is the reserve requirement, or RR. The reserve requirement is how much the banks have to hold in reserve at their bank. Say you gave $1,000 to the bank. They would loan some of it out, but then they would have to keep some of it at the bank. How much they have to keep would be the reserve requirement. To increase the money supply, you would decrease the reserve requirement. This is because if you lowered it, say, from 10% to 2%, they could loan out more money, therefore increasing the money supply. If you wanted to decrease money supply, then the government would raise the reserve requirement. Say you went from 10% to 20%, then they would have to keep more money in their bank, therefore loaning less money out and decreasing the money supply. Our next tool is the discount rate. The discount rate, or DR, is the interest rate that central bank charges commercial banks for loans. Say a commercial bank doesn't have their reserve requirement covered. Then they can loan the money that they need from the central bank to cover their reserve requirement, and the interest rate on that loan is the discount rate. To increase the money supply, they would decrease the discount rate to make it easier for banks to get loans from the central bank, therefore increasing money supply. To decrease money supply, they would increase the discount rate, making it harder for commercial banks to get a loan from the central bank. Our next tool is the federal funds rate. The federal funds rate, or FF, is the interest on loans from bank to bank. It mirrors the discount rate, but the only difference is that the discount rate is the central bank to commercial bank, but this is commercial bank to commercial bank. If the federal fund rate lowers, then the money supply would increase because it would be easier for the banks to get loans. And if the federal fund rate increases, then the money supply decreases because it would be harder for them to get loans because of the higher interest rates. Our next question is explain the cause and effect arrows for expansionary monetary policy. For buying, it would increase money supply for open market operations. It would decrease the discount rate. It would decrease the required reserve and decrease the federal funds rate. It would increase money supply if you bought bonds for the open market operations, because if you're buying bonds, you're putting more money into the system and therefore increasing money supply. It would decrease the discount rate because that would make it easier for banks to get a loan. It would decrease the required reserve because it would make it easier for banks to loan out money, and it would decrease the federal funds rate because it would make it easier for, again, banks to get loans. Then it would increase the money supply for any of these scenarios. Like, say, if you decrease the discount reserve, then it would increase money supply, decrease interest rates, increase government spending, aggregate demand, price level, GDP, and increase, not decrease. Decrease unemployment. Same thing if you did that, say like if the government decided to decrease the required reserves, then you would just go through those cause and effect arrows, and it would increase money supply, etc., etc. A way to remember these arrows is Mrs. Irma, I got a doctor. Please go diminish pain urgently. Our next question is explain the cause and effect arrows for contractionary monetary policy. For open market operations, you would sell bonds. For the discount rate, it would increase. Reserve requirements increase, and the federal funds rate, it would increase. The discount rate would increase because that would make it harder for banks to get loans, therefore decreasing money supply. You would increase the required reserve because then banks would get less money. Be able to loan out less money, therefore decreasing money supply. And again, with the federal funds rate, banks, it would be harder for them to loan from bank to bank because of higher interest rates, therefore decreasing money supply. Then that would, for any of these scenarios, if the government chose to enact one of these, it would decrease money supply, increase interest rates, decrease government spending, decrease aggregate demand, price level, GDP, and increase, not decrease. Increase unemployment. Our next question is, what is the impact on the money market graph? As you can see with the arrows in the corner, they say if the money supply increases or decreases. But it's important to remember that only the Fed shifts money supply. Any of those tools, such as open market operations, the reserve requirement, federal fund rate, stuff like that, that is tools of the Fed, and only they can shift money supply. That's really important to remember. So say if the Fed decreases the required reserve, then that would increase money supply because they have more money to loan out. On the graph, you can see it when it says MS to MS1. It is, that is the reserve requirements decreasing, and therefore increasing money supply, increasing quantity, but decreasing interest rates, just as the arrows say. Also, if same thing with selling, only the Fed can shift money supply once again, and say if they increase the required reserves this time, then that would decrease money supply because they have less money to loan out, and that would make MS go down to MS2, and that would decrease the quantity of money but increase the interest rates, just as the arrows say also. And yeah.